welcome everybody. Thank you very much for joining the Orange Accountants, third in the series of our practical SME webinars. Today our webinar is going to be about maximising your business value. As always, I'm joined by Pete, who's going to be in charge of questions and making sure we stay under control.
I'm Nicky. Hi everybody, glad to be here.
Thank you. Excellent. And our guest today, I'm very pleased to say, is Nigel Alps. He's the director of the Business Board.
Hello, everybody. Nice to meet you, so to speak.
Excellent. Yeah, we're all virtual meeting people nowadays. So fantastic. So thank you very much, Nigel. So Nigel, I mean, I could have selected lots of different people for this guest appearance, but I thought Nigel would be particularly appropriate because he's been on both sides of the transaction. He's sold businesses and he's also helped facilitate other people and advise them. So Nigel's going to be sharing his knowledge about the main topics that we've which you'll have seen when you booked, which are firstly how the value of your business is calculated. We're going to go a bit more in the scientific side, although it is a bit of an art, but we will be going to a bit into detail about that. Secondly, we're going to be talking about what makes a business attractive to buyers or investors, which is obviously good to know because it doesn't matter what the value is if it's not then attractive to a buyer or investor. So you've got to make sure all of that works as well. Thirdly, really interesting question, how do you find buyers? You know, sometimes you could be lucky and you just sit there and they find you, but you know, in most circumstances, and to get the best price, it is good to look at how you find them. And then finally, our main area will be what to do if you're one of the 80% of SMEs that can't sell your business. There's a lot, you know, it might be that you haven't actually thought about it, or it just could be that you just don't know how to. So we'll be discussing that as well. So I'm just going to firstly hand over to Pete, and he's going to just cover off a few bits of the housekeeping of how this webinar works.
Thank you very much, Nikki. Yep, so I know we have a few old hats here, but for all of the new people, this is a Q&A-led webinar. So whilst Nikki and Nigel will be doing a lot of talking, we are going to be pausing periodically throughout for you to pose your questions directly. So feel free to do that. We are using the chat function rather than the Q&A function because the chat function defaults to only being visible to myself, Nikki, and Nigel. So you can be as open with your questions as you wish. It's obviously about your business. You may not want everyone to know what's going on. And I will pass those questions on to Nigel and Nikki as best I can. So there's just to make...
There's a stupid question.
There's no such thing as a silly question, indeed.
Although David's question to Nigel about are they parking tickets on this board, which I'm sure they aren't, are they?
No, it's a very responsible.
I haven't seen that one yet. I should have moved it. You've seen it enough times, David.
So what I'd like to do, just to make sure we have all found the chat, could we just move the mouse around? And at the bottom, you should see the chat button. If you click on that, the chat will appear to your right. I'm sure we all know how Zoom works, but just to make sure we found it, could I have you all just pop a quick answer to the question, have you had a valuation of your business done before? Simple yes or no. If we could get some ideas from people there. Oh, already flying in. And whilst you're in the chat box, could I ask as well, what are you hoping to get from today's webinar? You've all come here probably with one burning question in mind. If you could give us an idea what that is, we'll come back to discuss it in a second. Until then, back to you, Nikki.
Thanks, Pete. So while you're busy thinking of your questions and trying to remember if you have your business valued or not, just want to go through, this is a series of webinars. So I just want to let you know the next two that are coming up. The dates are to be advertised, but we will send through everybody that's booked for today. We will let them know what the definite dates are. But the next one is in January, and we are going to be talking about covering the ways to grow your business using external communications. Because again, continuing on the theme of growth, And that webinar, we are very lucky. We've got Verity Blake, who's going to be our guest speaker. And then just a quick little snippet on the March webinar. Our guest is going to be Diane from Gardener Leader, who's a commercial partner there. And we're going to be zone on what the particular topic is going to be, but it's the general area is going to be about the commercial legal documents that you should really have as your business, which we might mention a few of them today about what things you do need to have together when you are ready to sell your business, and so the buyers would expect you to have. Okay, so Pete, how are we doing with our questions?
Very good. We've got a real mixed bag of people who have and haven't had a valuation. I think it skews slightly towards the no.
Okay,
but it's not, it's 60-40, I think, really. And in terms of why they're here, we had a classic answer from one person, knowledge and power, which I admire very much. But essentially, there's a mix of general...
We attract.
So we've got a mix of general interest, plus a few people who want to understand how to increase the value of their business. You know, what should they be looking at now, even though it's years away? Things I'm fairly confident we're going to be able to answer.
Good. That's good.
Just, have we got any idea of the sort of size of our companies that our audience sort of own?
Well, I'll tell you what we can do there, Nigel. Actually, I did prepare this poll if everyone's willing. I'll tell you what, we'll come back to it, shall we? Should we quickly do your introduction, Nigel?
Yeah, let's put a pin.
Sorry to jump the gun.
Ask that question. Let's just get that ready up there shortly for the pen. But in the meantime, Nigel, let me come to you. So would you be able to just tell me a little bit of your background and why we've chosen you? Well, obviously, I've already said why we've chosen you. You've got experience on both sides, but if you could just sort of...
thank you, Nicky. No problem. And firstly, thank you for choosing me. So much appreciated on that front. I've been running SME businesses for nearly 30 years now, and involved with various sort of mergers and acquisitions along the way. Started off way back in 1992, setting up a business in marketing to computer service or to IT companies offering marketing services. We grew that to about sort of £3 million turnover, and then from there, really, I think you're at that dilemma, and we actually went on the acquisition trail from there. So that's when we started acquiring businesses, and sometimes you can't always legislate for the obviously we can't legislate for the future. And I think some of the guys may have seen from my post that we actually, after our largest acquisition, had a fire of our big warehouse, and so sometimes the journey you go on sort of sends you in a different route. So the experience of that, the experience of running the businesses, now I've sort of moved across into helping others with their exit strategy, with all that knowledge, experience, the sort of dilemmas and decisions along the way. So I feel I can bring a lot more to the party, more than our friends in the corporate world, so to speak. So yeah, that's me.
Absolutely, and that's exactly why we brought you. There are obviously, you know, if you're selling a very large business, you'll usually have corporate finance teams involved, but you know, the SME market, there's not the same level of services around, and that's exactly where you and the business will fit in, isn't it? Which is perfect for our audience for today. So yes, so Nigel and Pete, what we're going to do is we're just going to have a look at what the potential value of people's businesses are, but there's also, valuations does depend on the size of the business as well. So I think we have a poll for that, don't we, Pete?
We do indeed, Nicky. Yes, so I'll just launch this in a second. It's a simple poll. We just want to get a rough idea for the size of your business in terms of your current profit. So I'll launch that now, and if we could just get that. It is anonymous.
It's net profit, so that's your bottom line profit, so your sales less all your general costs. not your gross profit.
Yeah, so it's worth saying as well, it is anonymous. I did make sure I set it to anonymous when we took this, so you're not revealing anything to anybody.
Yeah, so don't, it's not a problem if you're under $500,000. It's still going to have value. It gives us an idea and a range there.
Okay.
Super.
So I think I'm just going to give it another 10 or so seconds.
Okay.
And then if anybody else wants to pop theirs in, we've got
time to click.
Okay, so I'm going to end the polling, and I'm going to share the results there because I think it'll help everyone to understand who else is in the room. So we've got, as you can see, the bulk of people are in below the $500,000, and then we've got a few up to the 1 and the 2 million size, which I think is quite interesting. But hopefully that will help you, Nigel, zone in what you talk about as we go through.
Yeah,
absolutely.
So, yeah, there's quite a lot of people didn't vote on that one. But that's absolutely fine. It still gives us a guide of the audience. Super. Okay, so over to Nigel. We're going to go firstly through. Just one thing I just wanted to mention. What we're going through today is general guidance. If you need particular advice on your valuation, or indeed on any part of your sales business, we do recommend that you get personal advice for your particular situation, because obviously we will have to deal with some generalizations today, which may or may not be relevant, but hopefully there will be lots of snippets in here that will be useful. So so let's talk about how do you value business?
Super, thanks, Nicky. I think you're exactly right there. It is a sort of a generalism across the board with this valuation, because there are certain sectors that have a specific way of being valued. But if we take the most common method, I'm sure most of you know this, it's a multiple of Ebitda. So I'll let the accountant lady in the room answer what Ebitda is for everybody, in case there's any extra questions there.
Yeah, just so basically it's almost the same as your net profit. It's before earnings, before interest, tax, depreciation and amortization. So it's an adjusted net profit.
So it's how much you made before the accountants work their magic.
It is, so that's the cornerstone for the first part of the valuation. And with the EBITDA figure, with the profit figure, whatever we sort of like to call it, what we have to do is put in realistic figures for any buyers to basically see a transparent view of the business. So if the business is potentially run as a lifestyle business, or if you may be putting in sort of lower salary figures for yourselves so that it improves the profit figure to improve the EBITDA, all these sort of measures have to be normalized. So that'd be the first thing to do. So when you are running your business, if you can run it as sort of transparently as possible for any buyer to then be able to see exactly what they're getting without having to do a number of calculations and sort of changes to those figures. So if you own your own building, for example, you may want to then put in a market rent. So they're the bits that we would add in to get to the EBITDA that we'd use for evaluation. That makes sense as a...
Yeah, absolutely. And
absolutely does.
I was going to say there are questions coming in, and obviously, Pete, do let me know if there's any that you want us to answer as we go.
I'm not going to interrupt, so please do send your questions in as we're going through. What we will do is we will have a pause at probably after the next topic, and we'll throw them all in, because I don't want to throw Nigel off his game.
I just did see one that was relevant though on Ebitda. People were talking about where would dividends be in relation to that. Just so you know, so Ebitda doesn't have dividends in that calculation, earnings before interest tax, because dividends is a balance sheet item. However, for the purposes, as Nigel sort of alluded to, for the purposes of a valuation calculation, a market rate salary is put in for any working director shareholder into the valuation calculation. So if you are only taking, say a 20k salary, but actually if you were to be replacing the business, it would be £70,000, you'd put in another £50,000 in the valuation calculation.
I'd tell you what, actually, we did have a little worked up model that might help bring some of this to life with people. Shall I just bring that up for people? And that might be easier for you to talk through. Let me make sure I click the right thing. So we had, that should be, so hopefully everyone can now see the valuation method being sector dependent. Can I get a confirmation on that one?
Yep, I can see it.
Wonderful, thank you. Okay, so as you can see here, so in this model, we've said Ebitda is 1.6 million. And then we've touched on a few things that you've been talking about there. CEO salary would be knocked off because it's artificially high, or would need to be added in because it's not being paid at all. And you'd have to also cover off a sales director and a market rent cost because those people aren't high. The CEO is doing many jobs. And then do you want to talk through some of the other things that we've got up there, Nigel?
Yeah, I think in essence, it's basically normalised salaries at the market rate to run the business. And obviously, we're seeing the sort of the lease Bentley. You know, we can take.
Or lots of leased Teslas recently.
Yeah, I bet you have. I bet you have.
That's what we see a lot of.
And partners' salaries and things. So they're the things to normalise, and it's certainly not uncommon to see those in when we first sort of look at a company who wants to sort of start an exit strategy. So we just adjust accordingly.
Okay.
Indeed. So next up, I believe we have calculation of equity value.
So this is then obviously taking the EBITDA, the normalised EBITDA figure, and multiplying it out. And the multiplier is governed on so many different factors that we'll come on to into the next stage. But we've obviously just selected a sort of an industry standard. I think this was on a recruitment company, wasn't it, Pete, at the time? Was it?
Yeah, I think multiplier of 5 is relatively standard for recruitment.
Yeah, we will go through the detail of how multipliers work, of how they get selected later on, because they do vary greatly. Then we've got another one, I think, popping up, isn't there, Pete?
Then we had cash
adjustment. Yeah.
I think this is quite an important one at the moment, and where people do have surplus cash in the business, obviously this can be added to the consideration, and is one of the drivers that are making a number of business owners look at an exit strategy to get that their cash out, with the entrepreneurial relief at 10% as it is at the moment. So
at the moment,
that is, so it's quite a big driver at present. But the other bits to sort of consider within here, obviously, when you do sell a business, you need to leave in working capital, and generally that's sort of working capital probably over a 2-month period, something like that. So obviously we sort of put a figure in there, and
you'd have working capital to cover a certain amount of months of your general cost, but also to cover any taxes or anything that are due from the accounts that have already been done.
Sure. And obviously where you're owning the freehold of the building, that again needs to be sort of factored into the equation. What we tend to see and what we tend to advise is basically to sort of segregate that out, always put it there as an option if somebody may want to buy the freehold at a future date. But sometimes that can obviously escalate the purchase price, and it depends on who the purchaser is, whether they want to buy it and whether it should be included. But generally, we'd sort of segregate those apart.
Excellent.
Yeah. So just moving down this to slide, or is it my screen? What I was going to say, obviously, it's deducting the debt in the business, but the way to probably view the whole sort of understanding of what's included in a business is to just imagine on a sort of a Friday night, you sort of lock the doors, you take the keys, you've got to pass those keys on for somebody else to be able to unlock the door on Monday morning and run the business in the same fashion as you've been able to do it. So it needs working capital, it'll need stock of various items, it'll obviously have debtors and creditors that are then all sort of factored in. But equally with the machinery, some people often ask whether, you know, the machinery should be on top. Now, on many valuations, they need the machinery to be able to run the business. So on this particular valuation, the machinery is included. Sometimes it may be factored in at a higher level if it's a sort of specific specialized equipment, but generally anything that is needed to run the business is included within the valuation.
And that's where someone such as yourself earns their stripes, I believe, in whether or not it counts as working capital or is an exceptional.
Yeah, the valuation is probably the simple bit to some extent, and the next stages which we'll move through to is you know, probably I would think where we earn our stripes, which the hard work starts really.
Yeah, indeed. And yeah, obviously, as we mentioned, this is only one type of valuation because there are lots of different types. I think we're going to another. Are we talking about another one now, or are we going into the multipliers?
So I think we were going to go into the multipliers.
Okay,
next.
Fantastic. Let's go into multipliers.
So should we carry on with the screen, or would you like to just come back to yourself? Let's come back to you, Nigel, for a second. You can talk around this.
I mean, equally, I didn't want to change the format, but if somebody's, I mean, I saw one question there, if the machinery is old, which is a very good point. And all of those would absolutely affect the value to a certain extent.
Yeah.
Or maybe the marketability or the design. It depends on the sector as to whether the buyer or the purchaser would actually even want the equipment. They may be 4 or 5 times the size and have much more sort of advanced equipment. So there's then another equation, which I think you're coming to on the 4th point, Nicky. So yeah, it's but a very good point. I think the other aspect, just to add in here, is really each and every case is so different, and it just depends on the structure and what's on the balance sheet and how the business is run and their customers and everything. And again, the next stage will probably highlight some of these points.
It will. In fact, if we can move on, sorry, I'm just keeping an eye on the time. We do need to move on to the next point, which is the multiplier, which I think is the sexy thing.
Yeah, indeed.
It is. I think this is where you can really add value, because we'd all try and run our business in the most sort of efficient way possible to get the profit, the Ebitda at the best level. But the next slide, are you moving on to the slide?
I can move back onto the slides, yes, if that helps. I think it will help everyone. So everybody, we have moved on from the valuation. If you have any questions, pop them in the chat. We're going to come to questions after this section, which we are going to go through now. So I'm going to get that back up. So I believe to start with, we had the fundamentals, the base elements, Nigel.
Absolutely. So within this sector, we probably have to just also think who our potential buyers are. So when we start off with the size, it's really who is going to be interested in buying this business, and what value will they get from the work involved? Because any acquisition, any negotiation, looking, buying, and actually once the acquisition has taken place, there's another whole load of work with the different ethoses of merging businesses together. So all that has to be considered is what is the actual net reward of the acquisition. So generally, a company has to be of a reasonable size to make a difference to its purchaser. As a rule of thumb, we would probably say a typical purchaser may be 4 to 5 times the size of the company for sale, so that it makes a significant difference, a sort of 20-25% difference to the sales, the turnover, and then hopefully the bottom line. After saying that, moving on to the sector, if the company has a sort of a specialist area that they've been working on, then the size can go out the window. For example, a couple of months ago, we sold a vegan wholesaler to a £1 billion food distributor. Now, the vegan wholesaler they turned over sort of less than 500,000, but obviously the food distributor wanted to get into that marketplace, so hence that was appealing to them. Now, so for that particular,
sorry, that's an interesting point, Nigel, because that's what I also sometimes say to people, because another way of looking at the valuation is the cost. What would it cost you to go and set something up from scratch yourself? Because you often sometimes work, and so often the cost of that and the time spent on that is often, you know, more expensive than being able to buy somewhere. So that's another way that the buyer could potentially be valuing the business. What's the opportunity cost if they had to set it up themselves instead?
Absolutely. When we see all the inquiries come in and we look at the buyer pool, we always think and work out what it's actually worth to the buyer. And sometimes, depending on the sector, we don't really, we don't sort of put a figure on what the valuation is. We'd let the buyer sort of ascertain what it's worth to them, so that obviously in the hope they may put a bigger multiple on it, and if they've got deeper pockets, you know, there should be a better valuation and sort of more remuneration for the seller. So that you know, that's a very good point, Nicky. So size, it's a fundamental decider. The other sort of point with size is, if you're, and I noticed some of the profit figures were at 500,000 and 1 million, and obviously a little bit more. Those then sort of jump into a different marketplace of interest. So the sort of the private equity.
Well, Nigel, if I could say, because I know we're going to come on to how to find a buyer in a moment, but I'm conscious that we have got 2 other sections to get to on this. It's okay. If that's all right, I apologise. Anybody who had questions, please throw them out.
Sorry.
All right. So I think next up you had clients as an area.
Let me just quickly finish on these. I do apologise, but sector, obviously, if the sector isn't growing and it's quite flatlining and slightly stressed, then obviously it won't get the same multiples as a software company and such like. IP, again, software companies or somebody with particular patents, trademarks in a growing market, you know, obviously that would get significant, that would help the multiples significantly. And what somebody's buying is really the opportunity. So that's what it is. And I suppose the scalability of that opportunity. So yeah, quickly moving on, Pete, apologies.
It's quite all right, Nigel.
Clients. Yeah.
Yeah, we just got to be aware that people have got 1 hour lunch breaks, not 2 hour lunch breaks.
Okay.
Because we could
the
talk all
time on
afternoon, me and Nigel, about this.
No problem. So quickly whizzing through this then, the customer relationships, I think obviously paramount to any business. One of the first questions is the longevity of those relationships, who holds the relationships, and whether the acquiring company would be expected to run those relationships, or they'd be taking on the employees who would then run them, which would be the norm. Second question is the concentration. An ideal spread is where no customer is more than 10% or 15% of the total turnover of the company. It's not always the case, and if they are more, so be it, but it just starts to reduce the desirability because there's too much emphasis on one customer. Repeatable income stream, absolutely. If there's something that is then just a robust, continuing buying month in, month out, all customers are ordering, obviously that helps the multiplier. And contracts is actually a double-edged sword. A lot of people say, what are the contracts? Where are they? Let me have a look at them. But some of the customer relationships could have probably lasted 10 or 15 years, whereas contracts tend to have a start and a finish date. Obviously, more importantly, in this case, a finish date. So they're not always great to have loads of contracts, but a lot of buyers would ask the questions, but yeah. There is always a finish date. So that's fine.
And again, so the opportunity, sometimes the contract could be, it could be that it could be a framework contract, which the buyer doesn't themselves have a framework contract, but they can edge through by taking over the business and therefore have access.
Absolutely. There's a lot of opportunity through sort of crossovers there and everything.
Yeah, and then I think the next section was structure.
Okay, let me just move a little. So there's basic points that people always sort of say within these situations to improve your multiplier, and they sort of say, in an ideal world, no, and I'll just run through them. No, the business isn't dependent on one key person. It's got a second tier of management in place, and they can run the company, and the owner doesn't need to be about. The strong processes, it's the procedures are all in place. Everybody knows their roles and responsibilities, and the governance from ISO to policies for all the various different things we need policies for, health and safety and everything is all in place, and the business is future proof for the next 10 years. Ideal scenario. Unfortunately, it's not really the real world, and I think when you're running a business, it's great to think it's not dependent on me, but generally I'm sure most listening would agree, you're probably the drivers of that business. You're the ones that are sort of laterally thinking, looking everywhere, making sure that things aren't wasted, pushing it forward, putting the plans in place. And without that, the business probably wouldn't have had the momentum that it's had. So when people say your second tier management, get an MD in or something like that, I've got another viewpoint on that, because I believe if we look at the buyer pool, they may have an MD in there, and there may just be a transition of yourself as the owner to be in the business for a year, 18 months, whatever the time may be, for that transition period. But I think it's probably better to do it, and again, it's very much a generalization, sort of after the sale, because then what you've done is maximize your Ebitda and your profit, and also you're the one driving it, so you're also helping the multiplier. And there's some business owners that are just happy to know that their exit strategy is in place, so they don't have to think, what do I do in 5-10 years time when I want to exit? It's not a rushed situation, and they probably enjoy the process of working. Because in fairness, a lot of people, once they've sold their business, they then think, right, what are we going to do next? And so it's also that continuation of obviously working, really.
Absolutely.
So, yeah, go on, Nicky.
Sorry, I was just going to say that I was just going to go through a couple other valuation methods very quickly, and then we could go into some questions.
That would be very good, yeah.
Yeah, because so as Nigel has mentioned, some of those multipliers, the factors in there actually then lead on sometimes to actually just doing a completely different calculation method. So for example, the IP that he mentioned, now this particularly is in tech businesses or other ones that might have the patents, etc. Sometimes they would actually have their valuation not on multipliers at all, because they may be actually in a loss-making position. So you're obviously not going to have then a multiplier of that EBITDA. So then what you would do is have perhaps a future cash flow calculation, a future, net. Future discounted cash flow valuation calculated of the potential, and then do it that way. Other methods just very quickly. Certain sectors may just be completely on your revenue. So, accountants, gross recurring fees. Some marketing agencies may do it on a revenue basis. And there are a few other variations on those themes, but I think we've got quite a lot of questions, so I want to make sure Nigel has the opportunity to answer some of your questions.
Yes,
so,
we
Pete,
do indeed have quite a few.
Okay.
Well, let me ask, I'll start asking them, but can I just as well, if anybody's got wants to know about their specific industry and what elements there might be to it, there is a second Q&A section we're going to come to at the end. So if you pop in now your industry, Nicky and Nigel will be able to give you a bit of a pointer on the specifics to you and your business. We had one question around that sort of ilk. A recruitment startup is wondering whether acquisition, so buying businesses to increase value, is a good thing or not, and at what point he should start thinking about it. And then he has some follow-up questions regarding whether or not it should be, absorbed into the business or start creating a set of individual limited companies. So who would like to take that one, Nigel or Nicky?
Looks like it's me.
Nigel.
I think these are when it does sort of drill down into the circumstances and the sort of aspirations. What I'd probably do is take a step back and have an overall sort of strategy, some really long-term goal, but then also think, right, what are the steps to get to that? And also, one thing I do tend to sort of share at this point is sometimes big isn't always beautiful, and it isn't always what some companies want. So again, it depends on the sector, and it's also your journey in growing that company to whatever level you sort of put down there. And if it's then to sort of be at a high turnover figure and a high employee figure and running this, it's the responsibility and it's building that up. And if that's the strategy, it's really trying to make sure, and you do need the team on board to start off with, but have the team in place. Somebody, for example, like Nicky in a non-exec role, who is there and then just putting a sanity check on that growth path and what the economy's doing and what other people are doing with the industry to ensure that it's the acquisitions are sensible, and it's also post-acquisitions, the different ethoses of different people, different teams, and joining those together is quite a challenge. And so it probably needs a little bit of a team to help do that. So like a non-exec director.
Okay.
Yeah. I think so. Hopefully that's answered the question to the person who asked it. If not, or there's something you want further clarity on, please pop it in the chat. But if I can paraphrase, it's who are you planning to sell it to? Build something they want is the impression I got there from your answer, Nigel. We've had another question coming in. Someone was asking whether or not COVID has impacted the approach for valuing businesses in the short to medium term.
Shall I take that one, or did you, Nigel?
Well,
My quick answer is yes.
Likewise.
yeah. I mean, yes, but it depends on what sector as well, because obviously it's impacted certain sectors much more significantly. So the sectors that have been massively impacted, so hospitality, leisure, travel, etc. There's a very different view on how, because the buyer will have a particular view on, are they going to be impacted by another 6 months, 12 months, 2 years, etc. So that will massively change the valuation. Other sectors that haven't been so impacted, especially if their clients are again in similar sectors which haven't been impacted, there's not a massive amount of difference. Would you concur on that, Nigel?
I would, and there's probably a little bit in between where there's a business we recently sold, and the actual consideration on day one wasn't particularly huge, but what the owner did was actually sort of guarantee his sort of situation for the next few years on a good salary, on a sort of on an earn out, which generally we pre-COVID we don't particularly like, but so he actually got a good position for himself, his company, and for the buyer. He wanted this team in place, and with the knowledge that their customer base will come back in time. So it's just factoring that into the purchase, really.
It's whether they can wait for it to turn around again. Yeah. Okay.
So it's a good question. So I think we do have some more questions. One came in at the end, which is fantastic, but I'm conscious of time.
Okay.
I know we have 2 more topics, so should we crack on?
We will stay on. So anybody that has got time, Nigel and I will stay online until every single question is answered. But we just want to make sure that we get through all the main content first.
Yes.
So our next one, the key question was, how do you find a buyer? Nigel, how do you find one?
I think the first thing is to see who are the likely buyers, and we'd then have the client's input on that. We'd have our view, and the three areas really are somebody in the same trade as yourself, somebody in a related trade that to diversify into a sort of separate area, and obviously private equity. Now, again, it goes to our original points to sort of say which ones are likely, and a certain level of company, private equity, don't tend to sort of get involved, but then there's a lower tier of investors that do, but without speaking out of turn, some of those investors really just try and leverage the company's assets as opposed to paying for the business. They're sort of using the company's assets to buy the business, which works in certain situations for people where they're more have sort of co-directors who are elderly or something like that, and then that they want to get out in some shape or form. So it's seeing who the buyer is. It's going to the same market. We would then obviously do a suppression list so we didn't go to your direct competitors down the road. We then go to related trades, and there's also all the trade press and everything that the opportunities are advertised on. That would be the first stage. I can go into others after then, but probably.
No, and it's absolutely, so there are different, there's different types of buyers. Some of them you might be able to access yourself. If you really don't have a clue and you need help, then you would go and speak to someone like Nigel, his company, to help you find that pool. also the other thing about having the intermediary, it sort of then does, sometimes it's a bit too sharp having the conversation directly, so it is good having that in between person. The other thing, just while if any questions pop up, Pete, is I just wanted to mention, it is sometimes it's useful for something like this, if you've never thought about who your potential buyer is, we will offer a round table, so it will be just a small group, maximum 6 people, on a round table in a meeting thing like Zoom, so unfortunately we're still doing things virtually, with Nigel as well, just to brainstorm and talk about what your potential buyers, who your potential buyers could be, just to have a bit more of a think about that. If that's something that you would like to explore, do pop down in the chat so Pete will gather up those names.
Indeed.
Yeah,
I can make that easy.
Yeah.
Sorry, I can make that easy. If you are interested in this, and I think given what Nigel was saying earlier about build the business that will appeal to the type of buyer you want to sell to, identify who's going to have that strategic desire for your business and build something they would want. This seems very interesting. So if you pop a 2 in the chat, we'll be able to arrange that, and we'll make sure that it's all non-competitors. If we see anyone who looks like my competitor, we will just run a second round table. So pop a 2 in the chat if that sounds interesting to you. Otherwise, back to you, Nigel.
Just to quickly add into that, I think it's also because you're obviously on the journey running that business before the sale. It's putting it on a track that you want to be on and want to enjoy, really, in growing. So some of that is worth talking about, because it's actually quite a sort of challenging route at different times, as we've all found with this year, really. And I feel for some of the businesses that we sold last year, because obviously you get to know the buyers and the sellers very well, and then having something like this come along puts in a massive amount of pressure on any situation.
Indeed, someone's actually made a really good point there, that there's the psychology of the business sale. For some people, that business is their baby. My father, who did sell a business, referred to his as his mistress, which I'm not quite sure what that was about, but it's a very tight emotional connection between you and the business, isn't it? Even after it's sold.
Yeah, it's difficult to think about, what's it going to feel like if you're not thinking every single minute of the day about your business. It's a bit hard to conceptualize. Let's just, sorry, Nigel.
I was just going to say, I think the other consideration when you are selling is that you have been 100% on that business, and when you do sell, it's quite quiet the other side once you've finished you sort of time with the business. So it's important having that as part of your strategy as well, really.
Yeah, absolutely. Understanding what you want to do next. I mean, I already know what I'm going to be doing next when I step away a bit more. But not that I just plan my whole life until I'm 90, but I do. So yeah, but it is good to know. Some people may want to just do, might want a world cruise, or they will, go on to some charity boards, or they're going to set up another business. But yeah, it is a good idea to know what you're going to do, or just become extreme regular at their golf club.
Indeed.
Let's just go into the sad question, the worrying question. But actually, when you hear the answer, it's not so worrying. What if no one wants to buy your business, Nigel? What happens then?
Well, I think there's a number of things you can do, but basically, if we've sort of, it depends on the sector, but I think it's more of an accounting probably question, because it's a question of then splitting down the company into goodwill, into assets, and trying to liquidate from there. If that's
that's one option. But there's also the other types of sale, isn't there? As in sort of an MBO or.
Oh, for sure. Sorry,
yeah.
I thought, yeah. I was picturing your slide from previously.
Yeah.
I think one of the first questions is always, because is there anybody in the existing company that would have the wherewithal to be able to take over, to buy it with the owner's help? And quite often that's the best place to start, and certainly where we start, because we don't want to also find we've gone out marketing, we've had a few buyers, then actually they're selling to the chap that's worked for them for 20 years. So for that reason, and for the reason to just get it out so that anybody looking at the business isn't thinking, oh, are they going to go off and do their own thing with this particular employee? So that needs to be sort of put on the table. There is, I was thinking, you were sort of saying if there was absolutely nothing and there was no...
Oh, no. Just if there's no actual trade buyer or private equity buyer at the time. It could just be the wrong time to sell, couldn't it? So it could be that actually let's just carrying it on and then relook in 3 years. It could just be the wrong time in the market. Because there are peaks and troughs, aren't there? Sometimes there's just a huge amount of businesses for sale in that area, so it all gets a bit difficult. And then other times, just like houses, isn't it? Loads can flood the market, and other times it's hard to find a decent house.
Yeah, I think it is also back down to sector, and it's obviously picking the right sector, which will have a value when you sell it on and will be of use. So I think it's always important to have that conversation about who the buyers are, even now, and also not to grow the business too big, etc., etc., and do all the things that should be in place.
Yeah.
But really, the answer to the question, if you can't sell it, I think is more of an accountancy one than probably ours.
Sure. No, of course.
Yeah, from that.
Of course. Yeah. That's an accountancy. The other option, of course, is if you just decide, well, actually, I don't want to sell it, because you might have found a seller, and then you just think, actually, found a buyer. You might just go, actually, I don't want to let go now. I actually want to just keep it going and turn it into more of a cash cow. So that's the other round table that we are, just a segue, other round table that we are offering as well. So if you are thinking, well, actually, perhaps you don't want to leave the business yet, or it's just not the right time in your sector to sell. There's not many people that are looking to buy a load of restaurants or whatever at the moment, whatever it is. How do you turn your particular business into a cash cow? And we are offering a roundtable for that. And I'm sure Pete's got another number for that.
I do.
You want to put it into the cash.
I do have a number in mind. It's the number 7, because that's my favourite number. Number 7. So if you are interested in the cash cow conversation, how do you? Because it's very different, isn't it? You run it very differently. If your view is, I'm never going to sell. Yeah. It's all about getting the cash out and putting it somewhere that will grow. That's my nest egg. That's my retirement. If you're interested in the bits and bobs behind that process, just pop a 7 in chat, and there we go, and we'll see what we can do for you. So I think there's one final option, isn't there, Nicky? I think on our list.
We've done MBO, MBI, so management buyout, management buy-in. So you might be just changing the structure of your business. You might be liquidating, like Nigel says. Just go right. Let's just close and go. Other ones aren't actually seeing. If there's a cash cow one, to just keep it going but make money out of it. There's probably a minority situation, but there are some situations you just go, actually, I'm not really worried. You might be in a situation you're not so worried about a sale, as it were. You just want to make sure that you keep the business going with your name. For example, I've got had quite a few years ago now, a particular lady business owner. She was coming up to retirement, but she was really keen for her business still to go and to have a legacy. So she did sell it for a very, very small amount. Not the market amount at all, but it was under the proviso that you keep the business going and you keep the name of that business, and that was therefore her legacy. So she knew that business was still going with her name on, and that's what she wanted. Easily pleased.
Yeah, it's got the right result.
Not many clients easily pleased, but she was one.
Should we? So I know I'm conscious of time. We always like to end on time. Do you want to round off, Nicky, and then we are going to do questions until they are all answered. So please pop them in the chat.
So yeah, so just thank for everyone that's been attending. We are going to keep going as long as you want with all our questions. But in the meantime, thank you very much, Nigel, and to Pete.
Pleasure.
For all of our, we've got even more content we could have crammed in. It's just so difficult because there's so much going. So please do sign up for the round tables and things, and we will share even more with you. It's just such a huge subject. And we have recorded today, so we will be sharing the full recording to everybody that has attended and to everyone that booked but couldn't actually attend today. We'll be sending that out in the next couple of days once it's all been, whatever Kirsty does her magic with it. But also just a reminder, if you want to book on for the January webinar, you can put another number, which Pete will say in a minute, in the chat, so we can just then automatically book you on. So you can guarantee that you will be in the space, because these webinars are when we've got 100 people ceiling. So make sure that we get everyone in. So that's the one that's on growing your business with your external communications. Okay. And we also have our every other month business clinic. That's always on our website to book every other month, where we go through all the different government things that are going on every day that change.
Quite busy at the moment.
Okay.
Could I just throw in two other things,
indeed.
Nicky? So, right, when we send out the link, we are also going to send a link out to Nigel's LinkedIn if you want to connect with him. I believe he's available, very available.
Certainly am, thank you.
No problem. And one other thing, if you are going to have to head off early, I know people will have meetings. We've got a little survey that comes up just at the end of this, which it's just asking what we could do better, because we really want to improve these webinars. So if you could take the 30 seconds to fill that out, it'd be really appreciated. With that said, let's move on to questions. So we had an excellent one come through. Yep. So besides value, what other elements should be negotiated? For example, company car for 12 months, salary, position, those sorts of things. I think this is part of the normalization question. But also, how do you deal with earnouts and those factors? Yeah. So, Nigel.
Okay, I'll do a quick one, and then Nigel will go and show in more detail. So absolutely. It's not just about the cash that you get on the point of signing the contract, signing over your business. You may want to have either continued management role in the business in a salary capacity, or a consultancy capacity. You may continue, if you continue with a salary type role, you may continue with a company car and your healthcare or whatever else. All of those things are up for grabs when you have your discussion. It depends whether, of course, the buyer is wanting to keep you in the business or not. So all of those things need to be taken into the pot when you're considering what the offers are on the table. What other weird things have you seen, Nigel, in deals?
I think the main thing is that for business owners, when they've run their own ship for several years, or probably over a couple of decades, it's very hard to then go into an employed situation with those boundaries and everything. So there's a little culture. Absolutely. There's a little bit, depending on the size of the company. Obviously, they have to, normally there's a transition of a period of time. And yeah, certainly the package would generally be at a market rate for that person. But equally, it can still be sort of thrown into the mix that you've had this car, you'll carry on using this car, and you've always had this car, and so be it. And there's a balancing equation. Yeah, until the end of the lease or whatever. Yeah.
I'll just say one key thing. If you are going to have either a service contract consultancy or an employment contract to continue, think about the notice period, because they might want you and then you might all go sour or whatever. So make sure you've got a very clear notice period, so that if you do all fall out, they've got to pay you off and pay the full garden leave, whatever You don't want to end up with just a 1 month's notice.
I think also the second part of the question was on earnout, and generally when we're sort of acting for somebody, we try, the consideration is all agreed day one. It is what it is, because once a company is in somebody else's stewardship, somebody else's decisions and influence, it's the earnout and being paid over future profits of the business or whatever it may be, starts to get a very grey area, and typically they sometimes start to waver towards the end of any period of time. So the ideal scenario is agree the consideration. If it may be a certain amount day one, first anniversary, second anniversary, that a 2-year, 2.5-year deal, that's it, end of, and maybe you're in the business for that period of time, and that's a cleaner way to do it. After saying that, at the moment, with the current situation, post-COVID, it has changed a little bit, and so we've got to factor some of that in certain scenarios.
Yeah, indeed. And just one other thing, of course, if you've got a listed company buying you, which we've had recently from one of our clients, it may mean that you get a certain amount, but then you get shares in the listed company, or even options in it. So you do have to sort of that will vary a lot.
Absolutely.
Yeah.
And someone's made the observation that as well in next year, IR35 is going to throw a whole blanket of confusion on top of all of that, which I think is a good point.
Yeah, well, actually, I mean, IR35 is still relevant now. But what happens is sometimes people may be changing their role. Obviously, you can't just move from a salaried role into a consultancy role, but if you are going to provide a different type of service going forward, there is potentially the possibility that you would be doing it as a consultant. But of course, you need to get advice on, usually on sale, you'd have commercial lawyers and everything, so you would get advice on your consultancy contract and substance of what you are providing, to whether it would be allowable or not.
Yeah, I think I think there's one question that's occurred to me. Nigel, would you recommend a bit more? Would you recommend between two deals, one where there's a bit more cash up front and a bit less cash up front and no earn out, versus less cash up front and an earn out? Is there do you sway one way or the other for people?
Yeah, I don't really like the word earn out. I'd sort of call it deferred payments. And if it's deferred payments, it means you're going to get it. And it really depends on, I would probably then, the next thing, it would be dependent on the buyer. So hopefully in a situation, we'd have 2 or 3 interested parties who are putting their best foot forward, their deal on the table. And maybe it's not all about the cash day one. It might be, if you've got to sort of be in the company for a couple of years, it's the relationship between you and the new owners and how you get on and whether you can work with them and their approach and things. So I think there's a few more factors to throw in there, but I probably always prefer the word deferred payments to earn out, really.
Okay, and I guess that's another reason to try and really think about who you're going to sell to, because you want as many people involved as possible, so you have those kind of choices. I mean, moving off the earn-out question, we had another question here. Someone was curious to know, do you envision that Mbos are going to become more common? The thought here was that the younger generation, I like to count myself in that one, are a little bit jam today, not jam tomorrow. So they're more likely to pursue that kind of, I'm not going to go and build something, I'll just take this one type thing. What are your thoughts?
Personally, I think there's going to be a lot of businesses that will be for sale over the next probably 5-ish years, from all the baby boomers who are then really looking to sort of retire or take a step back. The easiest sale, or the sale of less resistance, is to an existing employee team who get on. I mean, it doesn't always work, but they know the business, they know the ethos, they know the people, and that's a lot healthier for the business, the succession of the business. So I think some business owners will take a view from that side of things, and so I think there would be more management buyouts.
Yeah. Okay. Interesting.
And
Nicky, do you have a thought?
Contra to that, I think it also depends on sector though. So there are, for example, in the accountancy sector, there appears to be less people that are interested in partnership now, because people are, they see, yes, in certain accountancy practices, the partners get huge salaries, but they see how much they have to work for that, and they might not actually be attracted by that. So it's different sectors, you do
Absolutely.
find a different level of entrepreneurial spirit.
Yeah, very true.
I agree. We have two more questions left, actually, so anybody wants to throw them in. I apologise, this one was asked much earlier. I should have asked. When you were talking about the considerations, normalisation portion, you mentioned about market wages. Someone asked, does that mean they should pay themselves a market wage, or can they just do dividends and just know when you're doing your back of the fag packet calculation,
Well,
you'll be thrown in?
It depends. So it will always be calculated, but I mean, you have got some businesses that do think it's a good idea, depending on who they're going to be bought from, because then it ensures the continuity in their salaries going forward. But it sort of varies. Nigel, what do you think?
I think it does, you're absolutely right, it depends on who the potential buyer may be, but the sum of when anybody's selling the business, I always sort of say, pretend you're not selling it, carry on running it as though you would, and all the normalisation we can factor in, because if that's what suits you, how you run your business and how you're doing it, that sort of carry on, running it in the best way possible, efficiency wise and everything. And as long as it's not anything extreme, there's always some sort of normalization for one reason or another. So I would, again, it's case by case, but I would probably sort of say that the closer it can be to the actual thing is better, but you may not sell for a couple of years, and so it may not suit your lifestyle and what you want to draw from the business, for example.
Yeah. Okay, thank you for that. I think one final question. Hopefully that answers the question.
Or make it goody.
Well, I think the way I'm reading this one, and I suspect someone knows a little bit more than most on this webinar. So, would you say because of COVID, the initial consideration on acquisitions is being reduced, with more being deferred consideration? So, Nigel, I hope that means something to you, because I have to admit I don't get it.
Absolutely, and I think any deal, you've always got to see it from both sides of the fence, so to speak. And so if you are selling, yes, at the moment, the consideration would be less, but equally, it depends on the sort of future security of the company, and really in certain sectors at the moment, I mean, we'd all probably agree, some companies have got to have really deep pockets to sort of get through the whole journey. And so it's then taking a pragmatic view and saying, do you know what, I'm happy with this consideration day one. And if I've got this earn out over 4 years at a 10%, there's a tax accounting issue here as well. But in the sense that it's trying to structure something so that it works for both parties. And again, that's where not just us, but any sort of broker or accountant would then be a buffer between those quite sort of intricate negotiations.
Yeah, that's. I think that's a good answer, and hopefully that has answered the question for the person who asked it. That's all the questions we've had. So I think we can round off for now. So Nicky, would you like to just wind up and say cheerio to people?
So hopefully this has given you a few ideas of how you can increase the value of your business. Pete, all of us are available for any follow-up questions. We will, hopefully you've got the information on LinkedIn. We'll pop into, Pete can just pop into chat or emails just quickly. But no, I think I'm very grateful to Nigel. He's got such great experience and had some great examples of real life situations, which is exactly what we wanted today. So thank you so much to Nigel. Thanks to Pete for keeping us on track, up to 1 hour 12, so that's not too bad. But hopefully you've all got good value from that. And please do also let us know of any other webinars, topics that you want us to cover in our Practical SME series. But thank you very much. So thanks, Nigel, and thanks, Pete.
Thank you, everybody.